Welcome back. It's my favorite day of the week. It's Tuesday. So Tim and Tim, your favorite hosts, we're back with Making Moves in Multifamily Live. And this week we're talking about buying and selling and holding property. So Tim, how the hell you been, man? I saw you were at the Sphere in Las Vegas last weekend. I really want to go there, so I'm curious to see how that went.
Yeah, man, talk about a place I would buy.
Really? Did you get
That
motion
place.
sickness like people have been talking about?
No, but I took Dramamine.
Oh,
Um,
that cheater.
I I had heard about it, and I will say there was definitely for the folks who don't know, there's a YouTube video where Bono's like in the video and he's constantly tumbling through the whole song. Well, the Sphere, the way it's set up, they literally have the ability to make the audience feel like they're tumbling, and
Oh,
yeah, so during that song, they imitated the video, and you're in the Sphere, and you're like, "Holy shit!" It feels like I'm
moving.
constantly going head over heels, and
Yeah.
I can see where if you had uh, any kind of motion sickness issues, that would happen. But man, that guys, I don't care who the band is. If you get a chance to go out there and just see a band in that venue, it is impressive. I've seen some concerts all over the place, and there's nothing like that place out there. Um,
Man, that
it is
Red Rocks has been my number one so far, but I've heard that
it's
the
different,
experience is completely different, but
different.
yeah, it's just incredible. So
I will just one last thing. Like I will tell you, like to give you an idea, because of the way the place works, like there are times when they'll like boom, they'll throw up a scene where it's like an outdoor scene, and it takes your brain a second to register that you're not literally outside. It's like,
it's
wait a
that
minute.
good.
Yeah, it's impressive.
Wow.
It was cool. It was really
Color
cool.
me impressed.
It was. So
All right. So this week we're talking about the mindset behind whether you're going to buy something, you're going to sell something, you're going to hold on to something. Um, I don't know how to say this politely, but that's kind of the crux of the whole thing. Um, there's no right answer here, whether you want to
nope.
whether you want to buy an asset, right? So I guess what we can do is we can talk about each scenario and kind of the pros and cons and maybe some things that you may or may not be thinking about. So if you're looking at buying an asset, right? That's number one. You can't get to step two, which is holding or selling, unless you buy it. So obviously, there's always a lot of different property for sale. There's always a million properties for sale, but sometimes there's very few good deals. And that is a very subjective line because it depends on what a good deal is to you.
To you.
What a good deal to me is versus what a good deal to somebody else might be could be entirely different things. Now, if you're looking at a brand new construction class A build, you might be happy with a 5% return because you're just parking cash and you don't really want to have to deal with anything. But somebody like me and most of my investors, they're looking for some return of 15, 20% plus IRR, internal rate of return. And typically new construction doesn't do that because there's not that much potential upside on the properties. So that would not be a good deal for me. Now, obviously, it is a good deal for somebody else. People buy new construction all the time. There's properties trading. There's so many properties that are just like, how did anybody make sense of these numbers? But that's a whole discussion for another day. Essentially, you have to go out and determine what your access to capital is, whether it's your own or somebody else's. Big fan of OPM. And if you're using OPM or your own, you have to identify and label what your buying criteria is, whether it's a certain cash on cash return, whether it's the ability to get in and get out at a certain point in time, whether it's a equity multiple basis that you're going after. There's a lot of different metrics that you can apply against your investment criteria. I know for me personally, obviously Tim and Tim, I like being transparent. I talk about things in real talk because well, I mean, got nothing to hide. I'm all about equity multiple, right? So if I can get into a property in two and exit it in 1 year to 3 years and double my money or come pretty close to doubling my money in a 12 to 36 month window, I'm going to do that. There's a lot of famous people, rich people out there that live by what is it called? The rule of 72. And what's that say? That you're going to double your money. How does that rule work? I don't even know how the rule works because I don't follow it. But something about being able to double your money over a 72-month period or something like that. I don't even know. Do you know?
Yeah. No, I'm not familiar with the
I
rule.
don't I don't know
I
because
don't pay attention to it because
I
it
don't pay
doesn't
attention to it.
factor into my business strategy.
Right,
So
exactly. So I want to be able to get in and get out. Like I have to have a strategy, an exit strategy for buying and selling. I'm using opium. Ah, yes, Cedric. Yes, I saw the jokes about my license plate as well. um, yeah.
Cedric, I never thought that now I look at his license plate completely different. Thank you for sharing that with us.
um, so yeah, so determining your investor or your own criteria is super important. Anything you want to add to that, Tim, in terms of like equity multiple or cash flow or whatever exit
Yeah, I
strategies?
mean, I mean, this and this is always interesting, right? Because it it's interesting in partnerships. It's interesting in just conversations around the coffee table or the coffee shop or whatever I'm trying to say here. But it all comes down, like Vitaly said, it all comes down to what your goals are, what your strategy is, what you're looking to do, and sometimes, not sometimes, it also comes down to where you are in your career, right? Like you know where Tim and I are, where Vitaly and I are, like we don't have right now anything I would consider a legacy asset. So I'm probably not sitting on anything at this point in time, right? It's honestly nothing that makes money for me when all I go sit on the beach and collect a paycheck, right? It all takes work, right? There's sweat equity, it's value add, right? So and with value add properties, there's typically a business plan. And like Vitaly's talking about, if I can execute that business plan in 2 years and get out, tap my equity, move it into something else, then I'm probably going to do that because there's the whole thing like Vitaly's kind of alluding to here, which is called the velocity of money, right? And if you look at like the curve on a value add asset, and some guys in GoBundance shared this with me a couple of years ago. They do what do they do? They do this, right? They start
They go
sharp and
up
level
and
out,
then yeah, they kind of level out. And they'll
and
go up over time. Don't get me wrong.
but your highest your highest level appreciation is typically in that first like 12 to 36 months, right? Like if you're on a 5-year schedule. And so it's like, do I want to hold for 5 and 2x, or do I go for 24 to 36 months where I got like a 1.6, 1.7x, pull that equity and go do it again? And that way, now I'm looking at like a 2.4x maybe over the same period of time that I would have 2x'd, right?
Hmm.
And I think that's what some people miss sometimes, right? Is yeah, holding for 5 years and 2x, and that's all cool and everything. But there's other strategies where it's like, hey, but what if I could 2.5 it, that same initial capital? What if I could 2.5 that in that same 5-year period, right?
Hmm.
Or even 6, right? Like even if it took me 6 to 2.5 it versus 5 to 2 it, then why not, right?
And then you're also, that's very high level math, but you also have to factor in the compounding, right? So like,
Right.
if you got $100,000 invested and you're saying 100% return in 5 years, okay, or you can take a 70% return in 2 years. I'm going to take the 70% in 2 years because now I can reset my basis, and now I
Right.
can take 170 and in 2 years maybe get another 70% on that. So you could do the math real quick. I don't know what it comes out to be, but if you consistently do that over time and you're continually moving the money into the next opportunity, so you're constantly in this like upward growth path, you're going to far exceed your equity balances than if you just hold it over a long period of time. And I'm not saying that you can't. I'm just saying that if you want to do it faster, it is you have to do the velocity of money. You have to move money around. And let me be clear, there is nothing passive about what Tim and I do. We
No.
absolutely run a business. We are involved on the day-to-day operations, the day-to-day activities. We're constantly buying and selling and repositioning and moving money around and doing a lot of things, not only for ourselves, but also for our investors that are along the ride with us. But there's nothing passive about what we do. At a certain point in time, there will come a conversation and be like, Tim, I'm kind of tired of doing this now. Can we just park some cash? But we're
Yeah.
not there yet.
Yeah, we're not in the park the cash mode. That's a really good term, Tim, because like some people talk about like institutional investor versus family office versus people like little low guys like me and Tim here, like parking cash versus actively deploying constantly and rolling it, right? Like we're not a park the cash operation, right? Like we're trying to compound, we're trying to build, we're trying to multiply. We're not to that point where we're having that conversation with our our wealth manager, where he's like, okay, you need to take this bucket over here and be very conservative with it. We're not in conservative mode, right?
Mm-mm.
And then and
I'm in
then
risk it for the biscuit mode.
and to be clear, that's a little bit of a joke, because like I'm not risking other people's money, for one.
No,
But
it's
but here's
calculated risk.
but here's a very good point, and this is kind of a softball segue, Tim. You guys might think we planned this, we don't. Um, you ready to
Come
knock
on,
this
I'm
one out of the
ready.
park? All right, here you go. All right, here we go. So risk it for the biscuit, right? So let's say I pull that equity out, right? And now Tim and I have equity that we can do our own deal. Are you maybe going to be a little riskier on a JV deal with me versus somebody else's money?
I'm going to be a little more risky with our money between the two of
Yes.
us,
Yeah.
right?
So
Because I'm willing to take on that risk because I can only blame myself if I lose my money. If I
yeah,
lose other people's money, I'm done for. Like
yeah,
the business is done for. That is gone, right? So you have to make sure that you're doing calculated risk. And there's some home run deals that we're going after with our own money, and that's fine. If I lose it all, I bet on myself. I took that risk. I knew what I was signing up for. But when you have investors signing up with you, they are counting on you. They are depending on you to do what you do professionally and provide the level of returns or close to it that you said that you're going to do. That's your fiduciary to your investors, and that comes above all else.
yeah, yeah, 100%. Like like with our investors, there's very little, if any, speculation involved, right? And but like with Tim and me, we may look at it and go, if this happens, then we may be able to see this. So here's our return without that. Here's our return if this happens. Are you willing to take a chance on this? And like, yeah, okay, let's do that, right?
Right. But it's clearly labeling the upside and the downside.
Sure, 100%.
Yeah.
So, and again, guys, we're talking about like our own money. So that's what also kind of plays into these buy versus holds, is like, hey, if sorry, buy hold versus sell, is, do we
Yeah.
want to yeah, buy versus hold, sell versus hold, is, do we have an opportunity to tap some of that equity and go take take a shot at something else with our own capital, right? Because that's one of the things, like, we talk to people about in our Making Moves coaching program, is like, at some point when you start, you may be doing 100% syndication, right?
Hmm.
Well, as you go, you may start to do 60% syndication, 40% JV, and then maybe it's like 30/70 or something, like, who knows. And the idea there is that at some point you would like to move into those legacy long-term assets that Tim and I can look at each other and go, are you kind of tired of busting your ass all the time? Would you like to take a vacation with the family and not be answering emails all the time? Okay, cool. So this JV that we've done, maybe we're just going to sit on it for a while, right?
Yeah, and, there's so this has come up at like abundance events, but it's also come up
Yeah.
with other wealthy individuals that we know. And Tim, I mean, this is kind of another softball for you. A wealthy individual, right? What do they say their return level requirement is in order to be set for life? I'm thinking
Dude,
about I'm you know who I'm talking about, who sold a very big business in Winston-Salem.
oh, yeah, yeah. So their return level requirement is basically just covering their. I mean, I don't know what the term is, but their requirement is basically they got to return. They got to cover their living expenses without touching their nest egg. Right, is essentially what they're looking for.
Well,
So
okay, maybe it wasn't as big as a softball as I thought it was,
no, I
but
struck out.
yeah, you struck out. Sorry, but that's the two-seam fastball right there.
I tried to hit left-handed on that one, folks. I'm sorry.
Um, so I've had conversations with a lot of wealthy individuals, and what they say is all they need to make is 7 to 8% on their investment,
Yeah,
and
yeah,
they're
yeah,
good.
yeah.
Yeah, see, you remember, you forgot, but it is a conversation that we've had in the past of people saying, "Look, man, I don't need 15 to 20%. I have my, you kind of alluded to it earlier. You have your conservative, like your money that you're just going to go like be conservative and wealth preservation bucket. Then
Right,
you're going to have your home run bucket, and you're going to have something in the middle, right?
right.
So your in the middle returns is going to be that 78%. Your wealth, what did I call it? Jeez, I'm having a brain fart right now. Wealth preservation is somewhere
Uh,
between 5 and 7%. right? So you have 5 to 7%, which is going to cover which will be your financial freedom number, right? It covers all your living expenses. Maybe you're taking a little bit of the money from the medium risk pile that's in the 7 to 8% range, but then you also have those deals that you're looking at that are in the 15 to 20%. And you know what? Here, go try to hit a home run with those numbers, because all of my living expenses and my wealth will forever be taken care of by these two buckets over here. So go play with this bucket and let's go have a little bit of fun and see if you can
Yeah.
actually really make something with this money.
Yeah. Cedric, what he's talking about here, man, is cash on cash. So when he's saying that 5 to 7% bucket, what he's talking about is, let's just use easy math here for a second. Let's say you have $10 million liquid, right? And your wealth manager looks at you and goes, you need to make 5% per year to cover the way you want to live and not touch the 10 million, right?
Mm-hmm.
Minimum 5%. That's your number. And that means, well, so, you need to make $500,000 a year return in order to cover your mortgage, cover your vacations, cover how you want to live your life, and not touch the 10 million. Now, ideally, you make a little more than that so that your 10 million does still grow.
Continue to compound. Yep.
But right, that's what he's saying. That's what your investment advisor is saying, is your number's 5% on your 10, and you need to go invest that 10 in places that make you 5% minimum. And so that's cash on cash, not IRR. If I could find investors that are willing to deploy at 5% IRR, like, I'd love it.
I got a lot of deals for them.
I got crazy deals for you.
Yeah, but so I purposely put it this way because I wanted to bring up a point of why so many people are struggling right now to raise money. Tim, softball question here.
Oh, shit, I already struck out once, brother.
Come on, if our return bucket is 5 to 7%, right? Why would I stop investing in real estate if my cash on cash return is not greater than is not in that 5 to 7% window?
Why would I stop?
What can you get today that provides that with no risk?
Oh yeah, I gotcha. A money market account,
money market accounts,
money market accounts,
CDs, high yield savings accounts that are all like 5.5% right now. So yes, that makes it very, very difficult to buy deals because you're not raising money from individuals. They're like, why am I going to put my money at risk when I know that my freedom number is 5% and I can do that essentially risk free right now? Right. So that's why you hear a lot of people are very liquid. They're sitting a lot of cash. They got it invested in CDs, money markets, index funds, and high yield savings accounts because they're waiting for some level of buying opportunity to come up where there's less risk. Right. Let's identify the risk in the real estate market right now. There's three major ones. Well, it's kind of two major ones that lead into one. They kind of come out to the same thing because it's a lag indicator essentially. But insurance rates are continuing to rise. In some cases, we've started to see them come down, which is very, very inspiring, which I'm very hopeful for. And the other one is interest rates, right? And the byproduct of those two things going up is a decompression in your cap rate, right? So what people are doing is they're like, hey, let's kind of see how much higher are these rates going to go? How much higher are the insurance rates going to go? And how much further are the cap rates going to decompress before we start to see some normalization in the real estate market? Yeah. At that point, I will start buying again because my risk has gone down, that I know that if I buy at today's numbers with today's debt and today's insurance rates, and I can make 5 to 7% or better, and I think that the upside is higher, that rates are going to come down and that insurance is going to come down, then I know that I'm going to make more money, right? That is how a wealthy individual will look at buying a class A real estate investment, is based on those exact metrics right there. I know a lot of wealthy individuals that look at property and they say, hey, I need to buy at X. I think he said 75 basis points. The cap rate needs to be 75 basis points higher than the debt in order to make a 7% return on my money. That's his metric. That's how he buys stuff.
Yeah, and guys, and we'll get back to one thing because Tim just threw another softball that I want to crush. But the thing is people are kind of talking to us right now. Is like, how are you guys buying? And I'm like, what do you mean? How am I buying? I'm like, I'm finding things that'll do 7-8%, and that's today, right? Like even if I just hold and I just say I think rates are going to be back, even just say 7, 6. 5.5% over the next 3 years, man, I don't even have to do anything.
You don't got to do anything.
I don't have to do anything. Just wait. If I'm getting 7% now and my rate's locked, there's a key, right?
Hmm.
My rate's locked and I'm making 7% now, and I just hold and they come down, they come down to, just from 8% down to 7. Cool. Guess what? I
Boom.
just made
The
money.
cap rate decompresses in the same, not the same basis point for basis point lockstep, but you will see,
Right.
remember the buying criteria of my wealthy individual friend was I need to buy 75, the cap rate, my going in cap rate needs to be 75 basis points higher than my current debt. Well, if
Yeah.
the insurance drops a whole basis point, then by definition, the cap rate can be a 1/4% lower.
Yeah. So
A
so
quarter
let's go.
percent on a $10 million property is a big number.
So with that in mind, let's go back to the sell versus hold conversation because Tim mentioned GoBundance. So Tim and I went into the GoBundance event with kind of this idea in our head, like because we talked to some guys and they'd said, I'm trying to liquid. I want to go liquid. Like I'm
Mhm.
selling what I can because I want to liquid because I think opportunity is coming. And guys, please don't take this as a timing the market kind of thing because I don't promote timing the market. I think it's a fool's errand. But at the same time, there are indicators that there are going to be some good buying opportunities coming up, right? So if you can go ahead and you can liquidate right now and get that equity, go ahead and get some of your earnings so that you do have liquidity available to pounce when opportunity presents itself. This is a really good time to be doing that, right? Not to this extreme, right? Not to this extreme. We saw people who did that in '08 and '09, and they made out like bandits when they bought in 10 and 11, right?
Mhm.
And so when Tim and I went to GoBundance, going back to that, the consensus around the room, man after man after man after man, for guys who have been doing this an extremely long time, they were all like, I got properties I'm holding, but for the most part, I'm getting liquid. I'm getting liquid. Like remember, Tim, we were in the big room. There's like 200 people, 300 people in there. How many people raised their hands? Like it was like, how many of you are
Half the
liquid
room
right now?
or more, maybe.
Over half the room was like, me, I'm
Yep.
liquid. And so guys, like if there's an opportunity, if you've kind of hit that point in the curve and it's like you're trying to decide, do I sell it? Do I hold it? What do I do? Like, I can't answer that question for you. It depends on your business strategy. But I know where Tim and I are. We're like, I think opportunity's coming and I can take that money and triple it, maybe even quadruple it over the next couple of years.
And something that I like to talk with people about a lot as well is I look at selling property quickly because I have opportunity pipeline that continues to stay
Right.
full. So I have places that I can move the money. I have places that I can move my investors' money. It's people that maybe buy, and I'm just saying this is a rough example because it's what's popping into my head. But say, for example, you're a guy that had bought 3 or 4 single family houses and you own them. And you've only bought one property every couple of years and you've just kind of collected real estate. And there's nothing wrong with that. You'll be very successful doing that, right? But you're like, hey, should I sell these or should I refinance them? And my question always is, if you sell them, where are you going to put the money? And they're like, I don't know. I don't answer with I don't know. I do know where I'm going to put the money
Yeah.
because I have opportunity, right?
Yeah.
So my risk profile and my business plan is different than somebody's that's going to say I'm just going to buy and hold this forever because I know where I can move the money to, right? And that knowing where I'm going, right, starting with the end point makes it a lot easier for me to make decisions in my business plan of buying versus selling versus holding because I know I have opportunity to move the money. I know that I will continue to have opportunity, and ultimately, I need money in order to continue to capitalize on these opportunities.
Yeah, so I had, and Tim, that's a really good point because I had 2 calls yesterday from 2 different brokers that we've worked with in the past. They both asked me very similar versions of the same question, which was, "Are you buying right now?"
Hmm.
Right? And I told them, I was like, "I'm always buying. Like,
Always.
I'm always buying." And the folks, the reason I say that is one, it's true, but two, why would I say no? Because that goes back to what we said before, which is don't try to time the market, right?
Hmm.
Like send me what you're calling me about. Let me look at it. If it makes sense, I'll buy it.
And my
Right.
favorite thing is opportunity is never lost. It just goes to the next person. So
Right.
when you say no, you're not even open to an opportunity. You have no
Exactly.
idea what's about to fall in your lap.
Exactly. Like he may be calling me about I got a 100 unit property in Charlotte, North Carolina for 50 a door, and the guy wants to sell
Done.
or finance the whole damn thing. And I'm like, oh,
Right.
cool. Like, let's
Right.
just go
If
ahead
you
and sign
said
that
no, it's
right
like,
now.
okay, I'm gonna go to the next guy. Like
Yeah.
Look, I know that that would be like a dream right there, but
Yeah, not
I'm not
realistic
saying it
probably,
couldn't
but
happen.
yeah,
Yeah,
who knows? I mean,
yeah,
but Tim, to that point, like we did have somebody last year show up and go, Charlotte, 100 a door. What do you think? And I was like,
done.
just let's roll out the PSA. Let's do it.
I got one in my car. Hold on, be right back.
But if I
Y-
if when he asked, would you look at a property? Would you be interested to look at a property? And I said, not right now. I would have missed that, right?
yep, yeah,
So,
absolutely. And man, that's powerful stuff right there. I swear.
mm,
But yeah, so like I know that there's we have not said anything definitive in this live show or our podcast today because there is no right or wrong answer, right? It
no,
depends on you, it depends on your investors, depends on your access to opportunity, depends on your sentiment of the market if you think it's going to go up or down, depends on your risk profile, depends on everything that goes on in your day-to-day life, depends on if you need the money or not. Like there's so many different things that can motivate somebody to buy or sell a property, but also, for those that are listening to this show, think about the people that are motivated to buy because they want to liquidate. Maybe they are a little more motivated to sell at a lower price because they want to have some liquidity. Maybe they do have a lot of equity locked up in this deal. So
yeah,
maybe they're open to seller financing as well because, well, now they can realize their gains and they got some money at work. It is an interest only loan and they still got their money, right? So, the possibilities are endless. I just don't want anybody to be closed minded to thinking that, oh, I heard it's all doom and gloom on CNN and that, it's the world's ending and, we're going into World War III and there's never going to be another real estate opportunity to buy again.
yeah. And by the way, one thing I want to leave you because I know we're up on time, but I want to leave you with
Yeah.
this because Tim made a really good point. It's all doom and gloom, but actually read the doom and gloom. Because I read something yesterday, and I wish I had it. I'd share it with you, where it was like, you know, Wells Fargo predicts the real estate market, and it was a bad prediction, right? And then you read the article, and it's like, and their prediction is that in 2024, we're going to see a 2.4% increase in values. And in 2025, we're going to see a 3.4% increase in values. Those are the key words, right? What they're saying is that we're not seeing double digit appreciation right now, which is true. And it's not historically sustainable, but we're still seeing appreciation. They're not talking about depreciation. And that's what I kind of want to hone in on, with folks is like, folks, everybody's talking about how bad things are. We're still talking about real estate appreciating, right? So, just keep that in mind. If you don't buy today, you're going to pay more tomorrow. Let's just keep that in mind. I mean,
Cool. All right, guys. Well, I thought this was a lot of fun. I have fun doing these shows. I really look forward to it every Tuesday. So, um, again, for the people that are hanging out, the last minute of our show here, today's the last day of our 50% off sale of our Making Moves coaching program. Reach out to either one of us if you want to talk to us about it. So yeah, we hope you can get started in commercial real estate because there are some buying opportunities coming. But yeah, reach out if you guys are interested. And with that, we will see you next week.
yep.
Peace.
Happy Halloween, folks.
Oh, I forgot today's Happy Halloween. All right, Reese's Cups.
Mm,
All
nice.
right, see you.